I'd like for us to take a survey of some of the striking indicators that parallel themselves between the years 2000 and 2015. Let's hear what some of the so-called experts are predicting for the future, and as we recognize what could be parallels between 2008 and the quickly approaching Lowell 29 of 2015.
On the verge of entering the darkest economic period in our nation's history.
America, which was a marvelous idea, a unique idea, a fantastic idea. I'm extremely pro-American, but America has ceased to exist.
We're talking about a prolonged depression. We're talking about massive deflation, massive unemployment, rampant bank collapses, a 70% best case scenario stock market drop. This could all start within the next 6 months.
Recently, all 16 branches of our intelligence community have come together to release a shocking briefing that contained an alarming consensus. These agencies, that include the CIA, FBI, Army, and Navy, they've already begun to estimate the impact of the fall of the dollar as the global reserve currency, and our reign as the world's leading superpower being annihilated in a way equivalent to the end of the British Empire post-World War II. And the endgame could be a nightmarish scenario where the world falls into an extended period of global anarchy.
In many ways, you say that we're in a worse shape than we were in 2007 as the recession was kicking in and the global financial crisis was happening. How are we worse off than we were then?
Well, the people that are running the U.S. government believe that by pulling monetary and fiscal levers that they can get the American economic machine to do what they'd like. And of course, this is a ridiculous conceit. And to save the country from a massive depression starting in 2007, they've been printing up trillions of currency units. Now, where have those units gone? They've all gone to financial institutions, banks, insurance companies, brokerage firms, to keep them from failing. And they've basically stayed there. So about 4 or 5 trillion new dollars have been created, but they're not circulating in society. They're sitting with those financial institutions.
So, and from your perspective, that would explain why we don't have rampant inflation yet.
Exactly.
Because this money has been created, but it hasn't been released into the general population.
Exactly, because they don't want to. I mean, what are they going to do with this this money? I mean, where's all the money going? It's why the stock market is at an all-time high. It's why the bond market is in probably the biggest financial bubble in all of history because of these things. But at the same time, people are not terribly interested in investing in plant and new businesses. It's hard from a regulatory point of view, and it's very iffy from an economic point of view. And this is very serious from the point of view of the government planners because they've shot their arrow. What are they going to do when the economy starts heading downhill again, whether it's the end of this year or I think certainly next year? What are they going to print up this time? 10, 20, 30 trillion dollars of new currency? At that point, the dollar really will become a hot potato. The foreigners will start dumping it. Americans, I mean, they say inflation in the U.S. right now is what, 1 or 2%. This is completely ridiculous.
Now, why do you say that?
Because if you watch yourself and keep your own consumer price index, you can see prices actually are going up right now, even now, in between 5 and 10% per year. Everything from the food you buy in stores to the meals you eat in restaurants. These things have been disguised.
Jim Rickards, author of Currency Wars, notes, the Fed is insolvent on a mark-to-market basis. The Fed has wiped out its capital on a mark-to-market basis. Of course, the Fed carries these notes on its balance sheet at cost and does not mark them down to market. But if they did, they would be broke.
For years now, you've been helping the Pentagon and CIA prepare for a rise in asymmetric warfare and financial threats. Because today there are immense fears we'll be struck by, as you've described it before, a financial Pearl Harbor.
There's now concern in different branches of the U.S. government. Historically in Washington, the Treasury and the Fed take care of the dollar. The Pentagon and the intelligence community take care of other threats. But what happens when the dollar is the threat? Americans generally know that the Fed has increased the money supply by $3.1 trillion. We have $17.5 trillion of debt. We have 127 trillion of unfunded liabilities. What are those? Medicare, Medicaid, Social Security, student loans, Fannie Mae, Freddie Mac, FHA. You go through the whole list, and it goes on and on and on. There's no way to pay it. During the boom years of the 1950s and 1960s, every dollar of debt that was created, we got $2.41 worth of economic growth. So that was pretty good bang for the buck. But by the stagflation in the late 1970s, that had actually collapsed. So now for a dollar of debt in the late 1970s, we were only getting 41 cents of growth. So obviously that's a huge drop off. You know what that number is today? Today we only get 3 cents of growth for every dollar of debt. So we're piling on the debt, but we're getting less and less growth as that trend goes from $2.41 to 41 cents to 3 cents. It's soon going to go negative. This is a signal of a complex system about to collapse.
When you look at the stock market, the only market actually rising, the only chart that actually shows continued rise is the stock market. Yet we're seeing volumes drop. A lot of people are not in the stock market, but the few that are there, they're taking out massive margin debt because, let's face it, are they chasing income? Are they trying to speculate to bring income in? Some of the fixed income people. You've been watching margin debt. What's been going on recently with the margin debt on buying stock?
Your major moves higher in margin debt were an indication of sort of the last gasp of speculation in the stock market.
It's always a sign of a crash coming.
Sure. 2000, the spike in margin debt preceded the decline in 2001. The spike in margin debt in 2007 preceded the decline in 2008 in equities. And 2014 is going to reach the history books and be one of those same periods. I think 2014 is an up year for the equity market, and it's either 2015 or 2016 where we see an absolute catastrophe in the U.S. stock markets. Well, June's numbers were in. We got those at the end of last week, and the June numbers were released. It jumped $25 billion in a single month.
So the margin debt is up $25 billion in 1 month.
That's right. And it's $1 billion off the all-time record number in nominal terms. And then if you wanted to say, well, nominal terms, things change with inflation. You've got to have some sort of a way of, calculating it. It doesn't just look at nominal values. Well, as a percentage of stock market capitalization, it is at its highest level ever. And that would beat 1929, and that would even beat the 1999 to 2000 period. As a percentage of stock market capitalization, the speculative money, that is, money borrowed from the bank to speculate in stocks, is at an all-time record high.
Jim, are you seeing any signs that our stock market has reached a supercritical state?
Well, unfortunately, yes, we're seeing a lot of signs of this. One of the ones that's really fundamental and really important is the ratio of stock market capitalization to GDP. Because remember, the value of all the stocks in the stock market, that's supposed to represent the fundamental economy. It's not supposed to be off in a world of its own. But if you look at what's been happening to that ratio recently, it's going sky high. It's 203%. Prior to the recession, that number was 183%. Go back to the famous tech bubble, the dot-com implosion of 2000. At that time, it was 204%. And if you want the scariest news of all, just prior to the Great Depression, that number was 87%. In other words, the stock market capitalization as a percentage of GDP is twice as high as it was just prior to the Great Depression. So that's a really good metric for saying, hey, is the stock market heading for a crash? All the data says, yes, we are. But there's another metric, another warning sign, if you will, that's even more frightening, which is the gross notional value of derivatives. There's a certain number of shares of IBM that are outstanding, but we know what that number is. But there's no limit on the derivatives. I can write options and futures on IBM stock all day long and all the other stocks on the stock market. And that's what's been going on. Now, the gross notional value of derivatives in the world today is over $700 trillion, not billion, 700 trillion. That's 10 times global GDP. This collapse is unavoidable. So, we ask ourselves, how bad can this be? Well, what happened in 2007, 2008 when the markets collapsed? We all remember the value of stocks going down, real estate going down, housing going down. All that lost wealth was $60 trillion. The problem is now the system is bigger, so I would expect the lost wealth this time to be $100 trillion, possibly a lot more. We're in this critical state, getting close to the supercritical state where the system implodes. But it takes a catalyst. It takes a flashpoint. There are a number of potential flashpoints.
Funded liabilities, excessive government spending are basically bringing the U.S. to the brink of some kind of economic catastrophe.
The U.S. dollar is the world reserve currency, and there's, who knows, 8 trillion of the things outside of the U.S. Right. And at some point, if confidence is lost internationally, all those dollars that are now abroad are going to come back in here to buy titles to properties, to corporations, to wheat, to Boeings, and the money supply will explode and it could be catastrophic.
Depression. That word brings to mind images of the 1930s and soup kitchens.
Well, we have soup kitchens today. They're just at Whole Foods in your local supermarket because 50 million Americans are on food stamps. It's not that we don't have distress. We have enormous distress, but it's being hidden in different ways. The unemployment rate today is actually 23% when you calculate it the right way.
And you point the finger right at the Fed, Congress, the White House.
I actually was in a meeting in the Treasury, and I said to the audience, the Fed and the Treasury are the greatest threat to national security, not Al-Qaeda, not some of the other threats out there, but right here in this building with this group, you people are destroying the dollar, and it's just a matter of time before it collapses. And I testified before the United States Senate about this. I warned the Senate, maybe we can't stop earthquakes on the San Andreas Fault, but nobody thinks it's a good idea to send the Army Corps of Engineers out there and make the San Andreas Fault bigger. But by money printing and credit creation and reckless monetary policy by the Fed, we're making the San Andreas Fault bigger every day. And when you make a complex system bigger, the risk doesn't go up a little bit, it goes up exponentially. So the risk is unimaginable at this time. The collapse hasn't happened yet, but the forces are building up, and that's just about to snap. Let's look at what's actually happening with the velocity of money. It's plunging. It's going down very rapidly. But compare this decline of velocity today to what we saw leading up to the Great Depression. Now, in the depths of the Great Depression, velocity was even lower. But if you compare what's going on today to what happened in the late 1920s, just prior to the Great Depression, there's a very striking resemblance. So it doesn't matter how much money the Fed prints. The Fed is trying desperately to bend the curve. Think of it as an airplane that's coming in for a nosedive. It's crashing, getting close to the ground. The Fed's trying to grab the joystick and pull the plane up out of the nosedive and get it back in the air. But unfortunately, it's not working. We're heading for a crash. The problem is not limited to the Fed. It's infecting the private banking system as well. There's about $60 trillion of debt on the balance sheets of our banking system. For a long time, debt in the banks grew at about 2 times the rate of growth in the economy. But lately, this has exploded. Today, it's up to 30 to 1. In other words, for every dollar of economic growth, there's $30 of credit being created by the banking system. The whole thing's unstable. There are a lot of signals out there, and they're very, very troubling. One of the ones I'm watching closely, and I know people in the intelligence community focus on also because it covers so much ground, is called the misery index. The misery index is when you take the unemployment rate and you take the inflation rate and add them together and then just sort of chart that. You look at the misery index today compared to the period of stagflation in the late 1970s and early 80s that Americans remember so well, it's actually worse. This can lead to social instability. Take this back to the Great Depression. The misery index in the Great Depression was at 27, but today it's at 32.89. Believe it or not, it's worse today than it was during the Great Depression. What happens as the depression worsens? Businesses can't pay their debts. The bad losses fall on the banks ultimately fail. That's happened before. The Fed's there to bail out the banks. What happens when the Fed itself is in jeopardy?
Based on these signals you've been tracking, the Federal Reserve is going to fail?
The Federal Reserve actually in some ways already has failed. Look at this chart. What it shows you is that the Fed has increased its capital. It's currently about $56 billion. That sounds good. You say, gee, $56 billion is a lot of money. That's a pretty good capital base. But that's not the whole story. You have to compare the capital to the balance sheet. How much in the way of assets and liabilities is that amount of capital supporting? When you look at that, it's a much scarier picture because the actual liabilities, or debt, if you will, in the Fed's books are $4.3 trillion. So you've got $4.3 trillion sitting on this little skinny capital base of $56 billion. That's very unstable. Prior to 2008, the leverage was about 22 to 1, meaning they had $22 of debt on their books for every $1 of capital. Today, that leverage is 77 to 1. So yes, the capital has increased, but the debt and the liabilities increased much more.
Regardless of which flashpoint unleashes the 25-year Great Depression, folks need to understand it's coming, and coming quick.